The global economy moves trillions of dollars every single day through high-frequency trading algorithms and instant digital settlements. Yet the information architecture underpinning these transactions was finalized in the year 1494. This page from the Summa de Arithmetica, published by the Italian friar Luca Pacioli, introduces double-entry bookkeeping, or DEB. This system requires every financial transaction to be recorded in at least two separate accounts, establishing the mathematical bedrock for modern capitalism. As we see in this handwritten ledger, the system organizes internal data into perfectly balanced bilateral columns. For a Renaissance merchant tracking inventory and cash flow, this dual column structure allowed a single entity to maintain precise internal control over their wealth. Double-entry bookkeeping operates in isolation. It manages the internal records of a single organization, but it lacks the native capacity to synchronize with the external ledgers of other trading partners in a networked economy. In the modern corporate landscape, relying on this isolated math has fractured the global economy into millions of siloed ledgers. We can see two corporate silos here, Company A and Company B. When they transact, they record identical data independently. Because Company A's internal database does not automatically communicate with Company B's database, we are left with a structural void known as the trust gap. Bridging this gap requires a labor-intensive industry of external auditing. Accountants must manually cross-reference these disconnected silos after the fact, or ex post, to verify that the numbers match. Modern cryptography solves this structural limitation. By upgrading double-entry bookkeeping into triple-entry accounting, or TEA, we are replacing bilateral trust and manual reconciliation with decentralized mathematical consensus. The accounting equation dictates that assets must equal liabilities plus equity. This scale morphs into a standard T account, dividing financial events into two sides. The left is a debit, the right is a credit, purely directional vectors adjusting specific balances. Every transaction recorded here serves a dual nature. It captures the financial aspect, which is the amount of money moving, and the economic aspect, which explains the assumption behind that movement. The T account captures this dual nature internally with perfect accuracy, but it remains a two-dimensional system blind to the outside world. We can observe the vulnerability this creates by mapping a standard transaction between Firm A, the buyer, and Firm B, the seller. Firm A internally debits cost of goods sold and credits accounts payable. Simultaneously, Firm B independently debits accounts receivable and credits sales revenue. If Firm A maliciously alters its payable to hide debt, Firm B's ledger remains unchanged. The isolated structures do not communicate. Because double-entry bookkeeping lacks a native mathematical link between opposing ledgers, the integrity of the global economy relies on institutional faith rather than cryptographic proof. Triple-entry accounting, based on the work of Ian Grigg and Alessio Faccia, introduces a mechanical solution to this vulnerability. Triple-entry accounting is frequently mistaken for the addition of a third column to a physical ledger. In reality, the third entry exists outside the firm's private books entirely. Rotating the T account reveals a Z-axis, creating the X account. It has four nodes: heading, debit, credit, and a cryptographic hash at the bottom. When Firm A and B transact, this irreversible hash is instantly generated, mathematically locking both isolated ledgers together. This hash is injected into a shared, immutable blockchain ledger. Because it is distributed across multiple network nodes, retroactive alteration is impossible. The X account converts an isolated, easily manipulated internal accounting claim into an externally verified network fact. At a macro level, thousands of transactions fire at once, their hashes weaving together into a continuous, unbreakable chain. This interconnected architecture eliminates the trust gap and forces a restructuring of how auditing and compliance function. Auditors traditionally rely on ex post sampling, checking a small fraction of transactions. Triple-entry accounting replaces that manual sampling with continuous, real-time verification of 100% of the ledger data. Pacioli's financial and economic dualism remains intact within the individual firm's ledger. Triple entry moves the verification of that data to an external shared layer. The blockchain serves as the objective third-party observer. It cannot be manipulated to hide debt, and it cannot be altered by rogue internal actors. Look at the massive physical hardware of this 1960s mainframe. Legacy Accounting Information Systems, or ERPs, Enterprise Resource Planning Systems, centralized corporate data. Today, blockchain protocols are dismantling that centralized architecture by distributing the record of truth across the entire network. As a result, the daily role of the accountant and financial analyst is moving away from manual bookkeeping and toward higher-level analysis. The machine handles the verification. The new professional mandate centers on strategic capital allocation and governance over the cryptographic protocols themselves. Triple-entry accounting turns the passive records of business into an active, verifiable infrastructure for the digital economy.